stage 3, risk management. Okay. I want to talk about stage 3 risk management. So while we put all this capital to work, you got to think in your mind before you even get started, how do I protect? If you don't have a risk management approach when you're putting money to work, when things start falling apart and the bullets start flying, okay, you don't have a chance of surviving. You have to already know your execution plan before you ever put $1 of investments to work. So this is the plan that we use, and I'm going to share it with you, okay? We have a stop loss entry, a trailed stop, raised stop entry, and targeted exits. This is our risk management approach, and I'm going to walk you through it in a little more detail, okay? So we call the first stop a principal protection stop, the next stop a break-even or raise stop, and the last stop a profit protection exit. And so what I want to do is walk you through an example of what each thing means. I'll show you on the chart. But to break it down real simply for you, when you put capital to work, you have to know how much you're willing to lose before you step aside, right? There's no holders at the ARMR Report, right? We don't hold on for dear life. We don't bury ourselves in an idea because we're sure that it should go up, okay? Let's remember right now that the stock market is not, a valuation machine as people pretend it is. It's a voting machine. Now, I didn't make that up. I can't remember who that was. Was it Graham from Graham and Dodd? Was it Black from Black-Scholes? I don't remember. Maybe someone can throw it out there in the comments. But that's a quote, okay? And I've probably totally bastardized it. But the bottom line is the market's not a valuation. It's not a scale. It's not a value. You can't look at an investment and say, it should be worth a lot more money because it's so valuable. That's not why stocks go up. The stock market is a voting machine. People vote. Okay? And if you think about it, when the Fed's reducing liquidity, a lot of polling stations are closed. Okay? So it's hard to vote. All right? That's the kind of market we're in. But anyway, when we put capital to work, if the market's not voting with you, you've got to know where you're going to stop it out. So there's your first stop location. Our favorite stop, our favorite principal protection stop is the low of the day we bought it. If the entry point's right, it should never go below the low of that day. The secondary point would be the low of the prior day. Okay, so sometimes there's a up bar and then you're buying the next day. Okay, so the low of the prior day is your stop. Those are the two best stops. Every time we do the analysis, it always comes back the same. Those are the best stops. And it makes sense. If you're buying right, stocks don't go down. So the low of the day you bought or the day prior is the stop we'll be using. That's our principal protection stop. The next stop is a raised stop. When the market goes up X%, and I say X because it's different depending on the asset, the volatility. Small cap stocks will go up more before we'd raise the stop. A big cap stock or an ETF maybe goes up a little bit less. And then an index, maybe the index only goes up 3% and we raise our stop to break even. Okay? Maybe a big cap stock has to pop 10%. Maybe a small cap stock goes up 15% before we raise our stop. Okay? So every stock is different. But once the stock goes up X%, and if you're trying to do this at home, you have to look at the volatility of the asset. Okay? And do your own homework and figure out what's a reasonable pop on this entry point. Okay, when it hits that first reasonable level. I can't give you the number. It's not a set percentage because everything's different. But if you look at it, you can figure it out. Obviously, the S&P is not as volatile, as for an example, as the IBD 50. All right, so the S&P's raised stop could be 3%. The IBD 50 might be 6%. Do you see what I'm saying? And then our third stop location, what we like to call the profit protection exit. As its name suggests, once the stock takes off, it's going to hit a reasonable swing trading target. ARMR Insiders, you can go look at the new spreadsheet we have under the portfolio page. And in our Slack room, I post it every day when we change it. And all of those targets are calibrated for the stock. And when the asset hits those targets, not only will we raise the stop to what was basically a trailed stop at that point, and it will depend again on the asset and how it's trading. The trail could be the 14, 25, or 50-day moving average. It depends on the asset and how far it is away from each of those moving averages, okay? We generally use as a target in a bull market where the Fed's adding liquidity, a big cap stock will run about 14.5%, and a smaller cap, mid cap name will run about 21%. Those are our initial targets for swing trading purposes. At that stage, we'll take some off the top. I don't care if it's 10%, 20%, 25%, whatever. That's our job based on the type of market we're in right now. Okay, so in 2020, with the Fed buying everything in sight, you might have just booked 10% off the top. Right now, 2022, with the Fed working against us, I might take 25 or 30% off the top when I hit that level. I'm also bringing down the level. Okay, so I might start booking profits for growth stocks that I think would usually run about 21% in a bull market. I might look for 14.5. At 14.5, I might book some profits, raise a stop. And when it hits 21%, I'll book some more. I might be out of 50% of the position at that point. That's because as a portfolio manager, I think I'm in a bear market and this is a bear market rally. And I think swing trading is better than investing. Okay, so I'm going to lean that direction in this market. For a big cap stock where I'm looking for 14.5%, I might look for 11% right now. It hits that price, book some profits, raise the stop, goes up to the 14.5%, book some more. Okay, that's how I'm going to be executing. And I'll be sharing this with you on the live desk.